Good morning everyone. We are from group BA2621A and today our group will be presenting a financial analysis comparing two well-known Malaysian retail companies which are Mr. DIY Group Berhad and Aeon Co Berhad, covering a 5-year period from 2021 to 2025. But before that, let us introduce ourselves. My name is Dayang Alia Arisha binti Awang Zamri and I am from BA2621A.
Hi, my name is Eleni Menti Ana Bagong.
Hi, my name is Dayang Atika Maisara binti Abdul Khaleb.
Assalamualaikum and good day everyone. My name is Masturina Najwa binti Muhammad Farid. So, before we begin with our section, I would like to briefly explain the contents of our report. Our report starts with the introduction and company background, where we provide an overview of Mr. DIY and Aeon Company Malaysian Berhad. Next, we analyze the company's financial performance using 4 categories of financial ratios, namely liquidity ratio, activity ratio, profitability ratio, and leverage ratio. After that, we present a comparative analysis between Mr. DIY and Aeon Company Malaysian Berhad from 2021 until 2025, followed by the discussion and finding sections, where we summarize the key results of our analysis. And finally, our report ends with the conclusion and references.
Financial analysis is important because it helps stakeholders like investors, creditors, and management understand a company's strengths and weaknesses and make better financial decisions. One key benefit is that it also allows us to compare performance between companies in the same industry. For this report, we analyzed both companies using 4 categories of financial ratios: liquidity, activity, profitability, and leverage ratios. These ratios help us evaluate how well each company manages its debts, generates profits, meets short-term obligations, and utilizes its assets. Our goal is to determine which company demonstrates a better financial performance and stability over the 5-year period. Let me now hand over to my group members who will walk us through the liquidity, activity, and profitability ratios before I return to present the leverage analysis.
Hi, my name is Dayang, and for my part, I will be covering the company background of both company. So let's start with our first company, Mr. DIY Group Berhad. Mr. DIY started as a single small hardware shop in July 2005 and has since grown into one of Malaysia's largest retail company, listed on Bursa Malaysia in October 2020. Their main goal is simple: sell everyday product at low prices under their famous motto, always low prices. Today, they operate over 1,000 stores across Malaysia and Brunei, offering more than 17,000 products across categories like hardware, household items, electrical goods, and toys, making them the market leader in Malaysia's home improvement retail sector. Now, for our second company, Aeon Company Berhad. Aeon has been in Malaysia since 1984, originally known as Jaya Jusco. Before rebranding to Aeon in 2004, unlike Mr. DIY, Aeon ran 2 main business: retail store operation and property management services. Their store offer a wide range of products from fresh groceries to clothing and electronics, supported by specialized brands like Aeon Wellness and Daiso. This combination of retail and mall management has made Aeon one of Malaysia's most trusted retail brands, particularly among middle-income families. Next, we will look into the liquidity ratio. For the current ratio, Mr. DIY performed better than Aeon over the 5-year period. Mr. DIY maintained its current ratio between 1.91 times to 2.38 times, while Aeon recorded as a much lower range of 0.50 times to 0.70 times. This indicates that Mr. DIY was more capable of meeting its short-term obligation using its current asset. Therefore, Mr. DIY performed better in this ratio. For the quick ratio, Mr. DIY also performed better than Aeon throughout the 5-year period. Mr. DIY recorded a range of 0.30 times to 0.62 times, while Aeon recorded a lower range of 0.14 times to 0.29 times. This suggests that Mr. DIY had a stronger ability to meet short-term liability without relying on inventory. Therefore, Mr. DIY performed a better in this ratio. For the net working capital, Mr. DIY performed significantly better than Aeon over the 5-year period. Mr. DIY maintained a positive net working capital throughout all 5 years, while Aeon recorded negative net working capital throughout the period. This indicates that Mr. DIY has sufficient current assets to cover its current liability, whereas Aeon did not. Therefore, Mr. DIY performed better in this ratio.
I will explain the average collection period, which measures how many days a company takes to collect payment from customer. A shorter collection period indicates better efficiency in managing account receivable. For Mr. DIY, the average collection period increased from 0.17 days in 2021 to 1.07 days in 2024, before slightly decreasing to 1.04 days in 2025. Although the collection period became slightly longer over the years, Mr. DIY still collected receivable very quickly, showing efficient credit management. Meanwhile, Aeon recorded a collection period ranging from 5.25 to 8.57 days. The period generally increased from 6.48 days in 2021 to 8.57 days in 2025, which means Aeon took a longer time to collect payment from customers. And based on the bar chart, we can clearly see that Mr. DIY consistently had much shorter collection period compared to Aeon throughout the 5 years. Therefore, we can conclude that Mr. DIY performed better in terms of account receivable management, as it was able to convert credit sale into cash more quickly than Aeon. Next, I will explain the account receivable turnover ratio. This ratio measures how many times a company collects its average account receivable during a year. A higher ratio indicates better collection efficiency. For Mr. DIY, the account receivable turnover decreased from 2,117.65 times in 2021 to 346.15 times in 2025. Although the ratio declines, it remained very high, showing that Mr. DIY was highly efficient in collecting receivables. For Aeon, the turnover ratio fluctuates between 52.01 and 68.57 times over the 5-year periods. The ratio improved until 2023, but then declines to 42.01 times in 2025, indicating weaker collection efficiency in the later years. As shown in the bar chart, Mr. DIY consistently recorded a much higher turnover ratio than Aeon throughout the 5 years. Overall, Mr. DIY performed better because it collects outstanding receivable more frequently and manages its credit more effectively than Aeon. Next, I will explain the inventory turnover ratio, which measures how efficiently a company sells and replaces its inventory. A higher ratio indicates better inventory management and faster sales. For Mr. DIY, the inventory turnover increased from 1.95 times in 2021 to 2.16 times in 2023, before slightly decreasing to 2.07 times in 2025. Overall, the ratio remained relatively stable, showing consistent inventory management throughout the 5-year period. For Aeons, the inventory turnover was significantly higher, increasing from 5.93 times in 2021 to 6.49 times in 2023, before declining slightly to 5.78 times in 2025. This indicates that Aeon was able to sell and replenish its inventory more frequently than Mr. DIY. Based on the comparison, Aeon performed better than Mr. DIY because it maintained a higher inventory turnover ratio across all 5 years. This suggests that Aeon managed its inventory more efficiently and achieved stronger sales performance. Moving on to the fixed asset turnover ratio, which measures how efficiently a company uses its fixed asset to generate sales. A higher ratio indicates better utilizations of fixed assets. For Mr. DIY, the ratio remained relatively stable, ranging from 5.39 times in 2021 to 5.55 times in 2025. Although there were slight fluctuations, the overall performance showed that Mr. DIY consistently used its fixed asset efficiently to generate revenue. For Aeon, the ratio ranged between 1.50 and 1.65 times throughout the 5-year period. The ratio was also stable, indicating consistent use of fixed assets, but at a lower efficiency level compared to Mr. DIY. Overall, Mr. DIY outperformed Aeon in terms of fixed asset turnover. This suggests that Mr. DIY was more effective in utilizing its fixed asset to generate sales and revenue. Next, the total asset turnover ratio, which measures how efficiently a company uses its total asset to generate sales. A higher ratio indicates better asset utilizations. For Mr. DIY, the ratio remains stable throughout the 5 years, ranging from 1.20 times to 1.25 times. This means Mr. DIY generated about 1 ringgit 20 cents to 1 ringgit 25 cents in sales for every 1 ringgit invested in asset, showing efficient asset management. For Aeon, the ratio ranged between 0.59 times and 0.63 times from 2021 to 2025. Although the ratio was consistent, it was significantly lower than Mr. DIY's, indicating that Aeon generated fewer sales from its total assets. Overall, Mr. DIY performed better than Aeon's in total asset turnover. This suggests that Mr. DIY was more effective in utilizing its total asset to generate revenue and achieve operational efficiency.
Now, I will present the profitability ratio analysis for Mr. DIY and Aeon Company Malaysia Berhad from 2021 to 2025. This section consists of 6 ratios, namely gross profit margin, operating profit margin, operating ratio, net profit margin, return on equity, and return on asset. Now, let's begin with the gross profit margin. Based on the analysis, Mr. DIY's gross profit margin increased from 41.2% in 2021 to 47.5% in 2025. Similarly, Aeon's gross profit margin also improved from 39.8% to 43.1% during the same period. Although both companies showed positive growth, Mr. DIY consistently recorded a higher gross profit margin throughout the 5-year period. This indicates that Mr. DIY was more effective in controlling its direct costs and generating profit from its sales. The increasing trend also suggests improvements in pricing strategies and cost management. Therefore, Mr. DIY demonstrated a stronger gross profitability performance compared to Aeon. Next is the operating profit margin. Mr. DIY maintained an operating profit margin of approximately 18% to 19% throughout the period, while Aeon's operating profit margin remained around 7%. This significant difference shows that Mr. DIY was more successful in managing its operating expenses while maintaining strong revenue growth. Despite minor fluctuations, Mr. DIY consistently generated a higher level of operating profit from its sales compared to Aeon. Overall, Mr. DIY demonstrated stronger operational efficiency and profitability throughout the 5-year period. Moving on to the operating ratio. Aeon recorded a lower operating ratio ranging between approximately 12% and 17%, while Mr. DIY operating ratios range between 23% and 30%. Generally, a lower operating ratio indicates better cost efficiency. However, this ratio should not be interpreted independently. When analyzed together with the gross profit margin and operating profit margin, Mr. DIY still showed stronger overall profitability. Therefore, although Aeon achieved a lower operating ratio, Mr. DIY was more effective in generating profits from its business operations. Next, we look at the net profit margin, which measures how much profit a company earns from every ringgit of sales after all expenses are deducted. Mr. DIY consistently recorded a much higher net profit margin ranging between 11.8% and 12.8%, while Aeon's margin ranged from only 2.3% to 3.1%. This shows that Mr. DIY was more efficient in converting its sales revenue into net profit and had better control over its operating costs. Although Aeon showed gradual improvement throughout the period, its profitability remained significantly lower than Mr. DIY. Overall, Mr. DIY demonstrated stronger earnings performance and better cost management. Besides that, return on equity measures how effectively a company generates profit from shareholders' investment. Mr. DIY achieved a return on equity of approximately 29.3% to 37.5%, whereas Aeon recorded a much lower range of 4.8% to 6.7%. This indicates that Mr. DIY was far more effective in utilizing shareholders' funds to generate returns. Although Aeon's return on asset improved over time, it remained well below that of Mr. DIY. Therefore, Mr. DIY provided greater value to its shareholders and demonstrated stronger financial performance. Lastly, return on assets measures how efficiently a company uses its assets to generate profit. Mr. DIY recorded a strong return on assets ranging from 14.2% to 16.1%, compared to Aeon, which is 1.45% to 2.3%. This suggests that Mr. DIY utilized its asset more efficiently and generated higher profits from its asset base. In contrast, Aeon's lower return on asset indicates that its assets were not producing profit as effectively. Overall, Mr. DIY showed good asset management and operational efficiency throughout the period.
Thank you. Now I'll be presenting the leverage ratio section. Leverage ratios tell us how much a company relies on debt to finance its operations and assets. We analyze three leverage ratios: the debt ratio, the debt to equity ratio, and the time interest earned ratio. Starting with the debt ratio, which is calculated by dividing total liabilities by total assets. Looking at Mr. DIY, their debt ratio consistently decreased from 0.57 in 2021 down to 0.48 in 2025. This is a positive trend. It means Mr. DIY has been gradually reducing its reliance on debt to finance its assets over the years, which reflects improving financial stability. Aeon, on the other hand, maintained a higher debt ratio throughout the period, ranging between 0.65 and 0.70. This indicates that Aeon depends more heavily on liabilities to fund its operations compared to Mr. DIY. So in terms of the debt ratio, Mr. DIY is in a stronger financial position with lower financial risk and better solvency. Moving on to the debt to equity ratio, which compares total liabilities to total equity. This tells us how much debt a company is using relative to shareholders' funds. For Mr. DIY, the ratio dropped significantly from 1.35 times in 2021 all the way down to 0.48 times in 2025. This is a very healthy trend, showing that Mr. DIY is now financing more of its operations through equity rather than debt, which greatly reduces financial risk. For Aeon, the ratio remained consistently high, ranging between 1.80 and 2.36 times throughout the 5 years. This means Aeon relies much more on external debt than on shareholders' equity, resulting in higher financial leverage and greater risk. And again, Mr. DIY comes out ahead with a healthier capital structure and stronger financial stability. Finally, the time interest earned ratio, or TIE, which is calculated by dividing EBIT by interest expenses. This ratio tells us how comfortably a company can cover its interest payments using its operating profit. Both companies actually perform well here. Mr. DIY maintained a strong and stable tie ratios ranging from about 10 to 11.5 times throughout the period. Aeon also showed improvement, rising from 7.96 times in 2021 to 11.22 times in 2025. While both companies are well above the minimum threshold, Mr. DIY's ratios were more consistent and generally higher, reflecting a stronger and more stable ability to meet interest obligations. That's all for leverage ratios. Thank you.
Now, let's move to the comparative analysis between Mr. DIY and Aeon. For liquidity ratio, Mr. DIY had stronger short-term financial strength, while Aeon faced higher liquidity risk. For activity ratio, Mr. DIY showed better overall efficiency, although Aeon performed better in inventory turnover. In terms of profitability, Mr. DIY consistently recorded higher margins and returns, making it more profitable than Aeon. Lastly, for the leverage ratio, Mr. DIY had lower dependence on debt and a healthier capital structure, whereas Aeon relied more on external financing. Overall, Mr. DIY outperformed Aeon in most financial aspects during the 5-year period. Now, let's move to the discussion and finding. Based on the financial statement from 2021 to 2025, both Mr. DIY and Aeon record a positive growth. Mr. DIY revenue increased steadily from 3.38 billion ringgit to 4.95 billion ringgit, with net profit reaching 632.7 million ringgit in 2025. This growth was mainly driven by store expansions and higher customer demand. Aeon also improved, with revenue rising from 3.63 billion ringgit to 4.29 billion ringgit, and profit after tax increasing to 133.8 million ringgit. Its net asset also grew, indicating stronger financial stability. Overall, both companies remain financially healthy, but Mr. DIY achieved stronger growth and outperformed Aeon during the 2021 to 2025 period.
Finally, for the conclusion at our 5-year ratio analysis, overall, Mr. DIY shows strong and consistent financial performance from 2021 to 2025, with healthy liquidity, improving profitability, and declining debt level. Meanwhile, Aeon faced persistent liquidity pressure and thin profit margin through gradual improvement across most ratios show a slow but steady recovery. Based on the overall ratio analysis, Mr. DIY Group Berhad is clearly the financially stronger and more efficient company compared to Aeon Company Berhad. That's all from my side. Thank you.